and welcome everyone to the 13th installment, I think, of Enduring Planet and Friends, our community event series for founders and investors and operators and really anyone in climate. This is a series that we produce monthly. Most of the sessions are virtual. Sometimes we'll do them in person at various climate weeks. Every time we do one of these, the goal is to be very tactical, very actionable, give folks real insights that they can then leverage to operate their climate companies or better invest or better advise founders. This will be a very dynamic session, so we encourage you to drop your questions in the chat. We will try to either respond to them as panelists or moderators or whatever, but also we'll chime in on the chat itself. The session will be and is being recorded. We will also produce some summary notes by probably the week of Thanksgiving, barring any surprises, which we'll share with anyone who signed up, even if you missed it. So it's pretty straightforward. We have a really incredible group of speakers here. I'm trying to think of what other housekeeping. Hannah, any other housekeeping items that I should flag? Great. Well then, Hannah, I'll hand it off to you to set the scene and take us forward.
This is awesome. Thanks, Dimitry, and thanks to our panelists for joining. We had more signups in one day for this event, which I think tells us all that we're bridging to not just the holidays, but it's on everybody's mind. With that, I want to hand over the mic to each of our speakers, maybe in the order of Alex Gershenson, Alexandra Wood, and then Ben, to say hello and where each of you are coming from professionally.
Sure, I'll kick it off. Hey everyone, my name is Alex. I'm a recovering academic, former climate scientist turned entrepreneur. I built SupplyShift, which was one of the first supply chain transparency platforms. Exited to Sphera about a year and a half ago. And now I'm helping founders navigate all sorts of interesting go-to-market and fundraising dilemmas at letsbuilditbetter.com.
Hi, everyone. I'm Alex Wood. I'm a partner in Orrick's Technology Companies Group and a startup and venture capital lawyer. Orrick is a global tech law firm with one of the most active venture practices worldwide, with deep experience in climate, energy tech, AI, hard tech. And I'm based in Austin and San Francisco, and my practice focuses on corporate legal work for technology companies from formation through growth phase and later stage financings, all the way through exit. I represent companies, founders, and investors, which has given me a broad view into how bridge and extension rounds are playing out in the current market and how legal and governance decisions today can set a company up well for the next price round or exit.
Hi, my name is Ben Conte. I help manage Susquehanna Sustainable Investments. We invest in early stage climate-focused startups across adaptation, mitigation, and removal, with a particular focus and emphasis on market-based solutions. So companies that really require very little or no rebate or tax incentives to get using Bill Gates's words, the green premium down to a green discount. Susquehanna is a large global diversified financial services firm with our roots in trading. We are also active not only in the public markets, but in the private markets as well.
Awesome. We have such a representation here on the call today with founders, the legal aspects and diversity across rounds, bridges and beyond. Ben in the investment side. I also represent Planeteer Capital, where I'm a venture partner for an early stage fund that we got going, have seen bridges go sideways, upwards, and backwards. And I spend most of my time as a fractional CFO across companies building large infrastructure projects. So like Alex, also help represent the kind of service providers to CEOs as they're making strategic decisions. And last but very not least, Dimitry, please introduce yourself and Enduring Planet and tell us what the heck is a bridge round?
Yeah. Okay, perfect. So for those that don't know me, I'm the co-founder and CEO of Enduring Planet. We do two primary things in climate. We are a lender to climate companies. So we provide working capital financing to folks who have creditworthy contracts, either with government or with commercial counterparties. We also are a fractional FinOps or fractional CFO firm. We now serve about 60 clients in climate. Lots of our clients have navigated bridge rounds in the last 2 years that we've run this business. And we also do this market education work as a service to the community to give back. I think the definition of bridge round means a lot to a lot of different people. And I think maybe we'll have a little bit of a debate around seed extensions and or extension rounds and bridge rounds and how they're different. But I think in my mind, a bridge round occurs when a company that is burning cash. So this is like only in the context of folks who are not profitable, right? The companies that are burning cash that do not have sufficient capital to reach their next proper financing event. And they need to raise some intermediate financing. And that might occur when they're performing, but just misjudged some numbers. It might be because they're not performing, but they think they might. And so that would be my definition. I don't know, Ben, Alex. I'm going to just call you guys the Alexes. If you guys disagree or want to expand.
Yeah, my only expansion would be,
That's a
you're talking about bridges to a round. There are also bridges to an exit, right?
Yeah.
So that's my only addition to that. So you're either bridging to a round or you're bridging to an exit.
Maybe also bridging to profitability. Like you might be really, really close and you just need that little extra bump of capital.
Yeah, that too.
I just offer, and I think this is going to something that we chatted about earlier, but I think of a bridge round as a type of financing and an extension round as being an indication of the price, right? So an extension denotes that it's the price or the valuation would be in many ways, shapes, or forms similar to the last round of investment, whereas a bridge round is a type of investment that is helping a startup that I think Dimitry appropriately called out as burning cash to get it from one place to another. So it could be like, you could use the analogy, one's a verb, one's a noun, but that's kind of how we think about it.
Are all extension bridge rounds, but not all bridge rounds extensions? I think that's it, right? Yeah. Okay. I think we got the definition out of the way.
Well, I'd love to hear from Alex from a legal perspective.
Yeah.
Right. What
is a bridge? So it is not a legal term of art.
Right.
So we wouldn't define a bridge meaning a specific type of transaction, but I think everything that everyone said, it gets you to the next place is how I would think of a bridge round. And some folks might include extensions. Traditionally, bridges were considered convertible instruments, like a note or a safe that gets you to the next round. But I think I look at it as the broader, encompassing anything getting you to the next place.
Now that we have this defined, I'm curious from the perspective of Susquehanna or Orrick, like, do you guys feel like there are more bridges happening right now? Maybe in like 30 seconds, is the market heavy on bridges today? Or is that some kind of confirmation bias that we see as a fractional finance firm?
I'd say yes. And probably over the last couple of years, I've seen more, whether a traditional bridge convertible notes or extensions. And I think there are a few themes, like milestones are taking longer. So climate, deep tech companies often rely on pilots, regulatory processes, hardware validation, and the timelines commonly slip. So founders need capital to reach the next milestone. That's one. Insiders are more selective. I think that's a real market issue. So that bridge support used to be perhaps more automatic, but now even insider investors want to see a clear use of proceeds and specific milestones before participating?
Yeah, I would echo what Alex said. So I think, rewinding the clock back to 2022 or 2023, um, yeah, there were a lot more of these types of rounds of capital that were forming by startups that were, looking for, more money to, stay in business or reach the next milestone or get them to the next round of funding. I think those are three sort of distinctly different things. We see a lot of them. I think that because there is a tremendous amount of kind of fatigue in kind of seeing these types of structures that investors both who are in the cap table and who are looking at an opportunity for the first time, there is some fatigue. So yeah, I would say that there are a lot of these types of transactions that are floating around the market. I mean, the entrepreneurs are doing the right thing, which is, being brave. There might be some opportunity out there. Public markets have been particularly strong, so why not try your luck? But there are a lot of these transactions in the market for sure.
Yeah.
I want
Uh,
to go ahead, Alex.
yeah, I just wanted to carry a little bit Ben's point of looking back. If we look back to 21, 22, the valuations were absolutely bonkers, right?
Mhm.
And so what I've seen in some of the clients that I'm working with today is that they raised at a very, very high valuation. They don't want to have a down round, so they will raise on a convert or on a safe, right, to get into a decent next round. And so they're delaying pricing until their revenues catch up with the very high valuation that they got during the crazy days of 21 and 22.
Okay, that's a super interesting point that we're going to come back to later about the dynamics of how caps and pricing can really affect founders through
Right.
subsequent rounds. But I do want to click on this idea of that you guys have distinguished of like what is momentum and a catalytic next step to unlock milestones or revenue or commercial progress versus what is the kind of bridge or pier to nowhere, and how do you tell the difference? We've got investors and service providers and founders in the room, but Ben, I'm gonna kind of jump down in our list and come to you first about like what are your heuristics when you think about defining the difference between a bridge that's setting up a founder for success or actively working toward those near-term milestones versus how do you sniff out what is the kind of bridge to nowhere?
I think it's, you're looking for a distinct set of facts that are, give you some basis to believe, right? So rewind the clock, look at your the initial thesis and the support that needed to, or the belief that you needed to have to make the first investment. And, did some of those things turn out to be correct, right? You and the founder are kind of, there's a set of promises, right? Or beliefs for you to enter into what, I've called a few times a spousal type relationship, right? You're gonna join arms with this founder and be there for a very, very long time, hopefully. And so it starts off with, okay, I'm going to trust you and you're going to trust me. And we're going to sort of say that within this reasonable boundary that we think these things are going to come true. And if you can and you hopefully you write those things down so you can refer back to them later. And then when you're looking at it from today's perspective, first of all, not everything is going to be true. Some things are going to be better, some things are going to be worse. That's just the way it is, right? But when you look back, it's like, okay, what were the inputs into the decision? How did those decisions play out? What were the results of those decisions? And so what can I credibly believe now? And so you're trying to create a sense of like what is realistic? What were my assumptions going in? What turned out to be true or false? And then what can I credibly believe next? So those are sort of a few of the things that we try to think about. And then you're pulling in a lot of other information. What are the market conditions? Is this industry still something that we think we can credibly believe in? Have the sands shifted beneath us? We've had a lot of uncertainty over the past 18 months, particularly in North America and the United States. So, what has changed? What hasn't changed? What can I credibly believe? And then what are the dynamics of working with the founder been like, right? And the founding team. Because, if you have a lot of evidence to suggest that they're being thoughtful and rational in their decision making through the process, that gives you a lot of hope, and also the ability to believe. If it's just been a big air pocket and you're guessing and you're kind of guessing what the founders are doing, it undermines, it's harder to believe. So
Yeah.
I'll stop there.
I think that's super important for the founders in the room, listening with the lens of like, what does your investor, once they're already on the cap table at the seed or series A, need to see as you progress through subsequent rounds? Like if you got to go to the insiders and your current cap table for bridges, one of the things I've seen investors asking for, if they're external investors, are send me all the monthly or quarterly updates you've been sharing with investors. So Ben's points about consistent touch points, keeping up with what your promises were, how you address them, if you didn't meet them or those goals, why and what fundamentally shifted, and why does that create a different pivot opportunity or more. But like the structured linear thinking that leads up to those milestones and confidence points that it takes to reach the next set, I think those are crucial. Maybe I'm going to come to Alex and Dimitry Gershensons. Give me some anecdotes. You both have raised bridges and extensions at various companies. Tell me like how that went down. Tell me about whether like what was your split, insiders versus external? How did you communicate this? Hey, this is really an unlock to the next phase and not just a kind of Hail Mary.
You want to go first, Older Gershenson?
Fair. Yeah, I think in my experience,
did I lose your audio or did everybody? Is it just me?
Just you.
Okay. Right.
In my experience, my bridges, I had some in the beginning of the journey and toward the end of the journey. All of them were insiders, right? And it was a frank conversation with my investors, with my board, of, hey, we're on the right track, but, right? And there's always a but, right? If there wasn't a but, then I'd raise my next round. So there was always a but. And the but was either growth is slower than we thought, or something happened in the market and our plans are changing, right? One very not fun exogenous effect was for me when I was raising around SVB collapsed, right? When SVB collapsed, the entirety of the venture capital community kind of froze. And so instead of raising round, I went to my insiders and got a bridge, right? So that had nothing to do with kind of market conditions or growth trajectory. It had everything to do with an exogenous event that led to an insider bridge instead of a round.
Dimitri?
I'm having some weird technical issues. Give me 1 second, guys. I'm sorry.
Okay, no worries, because Dimitri's going to pull us into the next section about communicating the different risk profiles of where you are with those bridges and how to kind of maintain urgency and momentum when bridge rounds are kind of, not inherently built on great progress, right? I wanna actually before we get there, I want to talk about the decision tree for founders that feels really difficult of should you fold versus should you bridge. We'll get into some of the mechanics of bridges and how they can go right and wrong later, but this is not this is not a common consideration, I think, for most founders, and yet taking this real honest look and not just waiting for the market to tell you, no, we don't have any more money for you, even in this bridge, like, sorry, you're going to hit runway. How should founders be evaluating that decision? Most of my founders that I work with would never consider that as an option, right? Like it's do or die, lash to the mast. But Alex, what early indicators do you currently advise founders on, right? Like at what point is product market fit not good enough? Like at what point is a pivot or a macro change existentially, damning? Like how do you help founders make that decision?
Look, let's be real. Founders, by definition, are not rational people in some aspects, right? Because a rational person would never start a company because your chance of failure is over 95%, right? So let's just start there. So to your point, very few founders consider a fold before they have exhausted every other opportunity, right? Typically, a fold happens when there is no decision of either a bridge or a fold, right? It happens when you've tried, you've knocked on all the doors, and there's just not a there for a variety of reasons, right? It could be market, it could be your growth trajectory, it could be the rate of burn relative to your growth trajectory. I mean, a million different reasons, right? What I typically, in the cases where I've worked with other founders that have been in that spot, right? The first step is how can you extend your runway without raising, right? Let's examine every opportunity. Yes, unfortunately, layoffs. Yes, maybe other financing mechanisms. Yes, going to customers to see if you can give them a discount for an early renewal to get cash in the bank, right? There are lots of ways to get cash in your bank account that are not a bridge, right? There are lots of ways to extend runway that are not a bridge. So the main thing to do is to look at every opportunity for extending runway, because really a bridge is a tool to extend runway, and it's not the only one, right? And so it's about
I would actually advocate that you should explore a lot of those things before you even consider doing a bridge, right?
Absolutely.
Yeah. The bridge shouldn't be your first choice. I think maybe I would add a little, I at one point had a long conversation with Sam Steyer, who some folks might know. He was a founder of a kind of a workforce startup in climate. And we actually wrote an insights piece on it, on folding, the choice to fold. And for folks who don't know Sam, he's the son of Tom Steyer and probably has some of the best access to capital in the existence of climate. And so for him, a choice to fold was actually very intentional because they probably could have raised more money ad infinitum, right? And I think his answer was really enlightening for me because they pivoted a couple times, they raised a little extra money, and they kind of came to the conclusion that unless they raised money to basically build a totally new company that just that wasn't at all what they were building before, raising more funds would just result in further like pivots and just like burning cash, right? And so I think for me, I agree. Like most 99% of founders are like, I'm gonna bang my head against this wall until I literally have $0 in my bank account. I'm not gonna give up. But I do think that at some point folks need to look at their own business and say, okay, we've been at this problem for X amount of time. We do not have pull from customers. Minor pivots won't solve this problem. Only like a total transformation of the business would suffice. And at that point, like a bridge of, X amount isn't going to get us there, right? And so at that point, it may make sense to say, okay, we still have, I don't know, 2 months of runway in the bank. We're going to pay off all the vendors. We're going to pay salaries. We're going to make sure all of our employees are whole, and then we'll return the rest to investors on whatever terms they want. And we'll just shut down because raising more capital just won't get us anywhere. And I think that requires a very difficult conversation across the co-founders. And I think oftentimes what people do is they try to make this decision themselves. Like the CEO will sit by themselves and will struggle with this choice. And they're like, oh, I have, this is the hardest decision. I have to make it. And I actually think my guidance is actually to do something very different, which is to pull in everyone on your team who might have an opinion, who might touch your customers, who might touch the technical side of the business, who might, and be like, hey guys, are we being honest with ourselves about the business that we're building? And this is where like collective input, I think, has a lot of value. And maybe Alex and Ben might disagree on this, but and I don't know, anybody might disagree on this, but for me, it feels like a place where that decision should not be made alone.
Tricky balance to bring in, and also to think about team momentum associated with those types of conversations. But absolutely, Dimitry, having your kind of like board of advisors and rivals who can really challenge you on those pieces are critical. Ben, I wonder if you've seen this. I've seen a number of founders also have the ability to raise more capital, and for various truths that they have uncovered about the business or the product market fit or the market trajectory, if they have another heuristic is if you have enough capital in the bank to return 1x to all investors, like return the money, that's one way. Another way of thinking about like, hey, I didn't lose anyone money in this experience. We learned a lot. Like, yes, it's a tough decision, but that doesn't mean that we should raise the money even if we can. Ben, have you seen any bridges in particular where the founder said, nope, that's the wrong move for either terms or their kind of advisory boards telling them that's the wrong move and deciding not to take it?
Not often. Just kind of struggling to remember anything that happened like that. I would just kind of go back to what Alex and Dimitry mentioned about, and just to double click on this idea of folding. I think if you're considering that, first of all, you've probably felt that somewhere intuitively in your gut or your spirit or wherever it is for a while, and you're just like kind of getting up the courage to actually talk about it. You should really talk to your investors about it. And then you should proceed with full transparency through that process, because the ultimate goal, like a startup, is just a series of hypothesis tests, and you have an idea or have an inkling around how those first couple of hypotheses are going to work out. Reality is, things don't often work out the way you think they do. But the most important thing is to be transparent with your investors through that process, because in many cases, and we see this when we're evaluating a incredible founder with a great idea, and we sometimes conclude like great founder, they just picked the wrong idea. So what you're hoping for, if you do end up folding, which is really not, it's, as Alex said, it's, you're 95% to fail, is to be able to call that for that investor. And that's what we want as investors, is we want to be the first call. Like we want this, even if the result was bad, we still really want that first call when they decide to do the second thing that they're going to do.
I love how you said when, not if, because that's
when.
real.
It's true.
Ben, I mean, I often hear from investors that it's really the founder and the team that they're investing in. So that would make sense that for the next venture, you don't consider the first venture failing like a blocker to investing in the next venture.
We are all people. Life is long. There are many, many examples of founders who have wound down companies who then go on to be operating partners at the funds that backed them. And that type of transparency and relationship building is the investment that you're making there. a lot easier at the earlier stages to deploy some of the tactics we've talked about today, right? When you're pre-seed, seed, even Series A, to return capital to investors or to take care of employees through runway, et cetera. Much harder when you get into the later stages of scaling, but still worth thinking about. I have a last question before Dimitri's going to pick up on exactly this communication point and like how to talk about momentum and avoid perverse incentives. But Alex Wood, question for you about what percentage of bridge rounds would you say result in the kind of net positive unlock for the company to keep going, keep raising capital, and actually unlock those milestones versus what percentage of bridge and extensions do you see that can threaten the business with either existential terms or dynamics that make it hard in the subsequent years?
I don't want to answer like a lawyer, it depends, but it really depends. I I have more often than not seen bridges lead to the next round or exit or next stage for the company, but that's likely because of the alignment between the company and the investors to do the bridge. So, I mean, it's of course there are companies that then end up folding ultimately, but I see more often than not that all of the negotiation and the terms and what's led to the bridge round and the alignment has led to the next step for the company.
Um, Actually, I just realized another type of bridge, and this has to do with folding, right? It is a small bridge to fold because winding down a company costs money, right? And if you kind of drop obligations, then there are all sorts of liabilities. So there was one company that I worked with that couldn't raise the next round, and they got a bridge to fold so that the liabilities are covered and all the vendors are paid and things like that. So I've seen that as well. And that's a sad bridge, but that's also a reality that folding a company costs money.
Yeah, and I mean, I think that that probably prompts the one piece of advice that a lot of people forget, which is that you shouldn't leave it until you have zero to fold.
Yes.
Like, remember, um, it's and in some cases, I think people have options where they can get it pretty close to zero and still survive. And in those cases, obviously, like you don't want to start folding 3 months early because you're like, oh man, I need to have 100 grand in the bank to pay all the obligations. But it is a real issue, and it can put you in some pretty tough places if you wait too long.
And similarly, you shouldn't wait to the last minute to start raising a bridge round. Those discussions should happen a lot sooner. You should be looking at runway and having considered all the other options that Alex raised. But you don't want to leave that to the last minute either.
Yeah, and I think I don't think this has been said yet, and maybe I'm gonna maybe be a little spicy, but even though bridges are generally insider funded, it doesn't mean that they're friendly. And the longer that you wait, the less friendly they are likely to be, because every investor then has an opportunity to take whatever they want to keep you afloat. And so there's this strategy around how you navigate this process from a time and communication perspective, where if you're raising a bridge with 2 weeks left, it's going to look very different than if you're raising a bridge with 6 months left or with 3 months left. Um, and I think, Peter, to your question, like I'm going to give sort of an Alex Orrick answer, which is kind of it depends. Our experience right now, and Ben, I'd love to hear your thoughts from all the rounds you're seeing. And actually, Alex will also see this too. But our experience is that right now, rounds for not ridiculous AI companies are taking, on average, between 6 to 12 months to come together. It used to be, I think, back in the like hot days, it was like 3 to 6. I think it's much longer now. Bridges can be done very quickly, especially if founders are willing to kind of eat it on valuation or cap. Um, but I would say probably, typical timeline for a bridge is anywhere from 1 to 2 months is what we're seeing, whereas a full financing round is 6 to 12. I don't know if you guys agree with those timelines.
You mean for fundraising and then from that point to term sheet to closing is the
Yeah,
6
I
to
mean,
12
like
months?
my sense is, the average Series A or seed right now, like from the moment you start having conversations with investors to the moment that you actually get money in the door is longer, and it's like probably 6 to 12 months in our experience.
Yeah, and it's true. The caveats in my experience are, yeah, the AI or other hot technology companies that can turn very quickly. But yeah, the discussions are having, I think, a longer trail. But once you get to the term sheet, it could be a few weeks to close the round, but it's that getting to the term sheet that is taking longer. And then while a bridge can be a shorter time to negotiate, I have seen protracted negotiations if you don't have that investor alignment to the point we've been talking about getting alignment earlier on with your investors and talking to them earlier on and not leaving it to a later point where negotiations can get drawn out.
Okay, let's shift gears a little bit. I want to pick up this thread that I think Ben highlighted earlier around um, kind of like the communication of risk, urgency, momentum. I think there's a lot of nuance here. And so I guess maybe let's start with I'll hand this to like the other Gershenson and Ben. Um, what do you think is the right level of transparency around burn, churn, risk? Like how should founders balance candor and self-sabotage? I generally probably over-rotate on candor in a way that's maybe not super productive, but I'd love to hear your perspectives. Maybe actually I'll start with Ben and then come back to my brother.
I would be unlimited in my candor. It's there's no use, or it's not worth anybody's time to be trying to hide the ball in any way, shape, or form. There's a high correlation between, investor quality and their ability to kind of continue to fund and their ability to sniff out or kind of find out where the holes are. If you're open and transparent and like, hey, here's the risk. This is what we think it represents. This is how we're trying to manage it, but there's some of it that's just risk. We're going to have to bear it together. That's a great conversation as an investor. If it's, oh, we're not worried about this, we're kind of whistling past the graveyard, it's no big deal. We think we're going to turn them around. They told us no, but we're going back in there. It's like, you kind of, it's a series of, I, I want to believe what's allowing me to continue to believe rather than I'm just not sure. Like, I'm not sure I'm getting the truth. I'm not sure I'm getting the whole truth and nothing but the truth. That's a really damaging pattern of fact and one you should try to avoid. So I don't use Dimitri's phrase, I would be, overly candid. These investors, should be, they're in the business of taking risk. So you should be able to communicate with them about risk and how you're managing it and have a thoughtful decision about how to make rational decisions with the uncertainty that's involved.
Yeah, I will sign on the dotted line on infinite candor with a couple of caveats. So bridges at an early stage, right? The numbers, yeah, you can be transparent with the numbers, but the numbers are not very useful because you're just starting, right? And so there you have to be transparent and honest with your investors about the market, about the opportunity, about the competitive space, right? Which is much harder to be objective about as a founder than when you are at a later stage and you've got, here's my pipe, right? Here's my MRR, here's my NRR, here are the metrics, and this is what we expect to do, right? It's much easier to be intellectually honest when you've got numbers than when you are really talking about feelings, right? You can be honest, but as a founder, again, there is a distortion of reality that you create for your team, you create for your investors, you create for the market, and you end up believing it yourself, right? And it's not a deception, right? It is not, or at least it is not an intentional deception. But full transparency. I mean, I'm biased. I ran a supply chain transparency company, and one of the values of SupplyShift used to be build transparency in all aspects, right? So I'm a big believer in transparency because there are no surprises later on if you tell the truth. But as a founder at early stages, sometimes you actually are blind to the truth yourself.
Maybe one question I would ask here, and then Hannah, you can take over for a second, is like, how early should this start? So, oftentimes folks will send their investor updates, things aren't going perfectly well. You don't always want to be like, oh, we like lost this customer, or we churned this one customer, or we're worried now, like, because things change, right? Every month things change, every quarter things change. So at what point do you start communicating that you think a bridge will be required? And do you do that in your written quarterly updates, which can be shared around? Do you do it in private calls to key investors? Like, I think that the tactics there also matter, and I'd love to get your guys' like maybe 30-second thoughts on that before we shift gears. Who wants to take it first?
Ben?
All I'll say is, like, I think monthly updates, I think Dimitry, you were one of the earliest advocates, I think back in 2018 or 2019, and I think they're incredibly valuable. I would just say, if you're going to start doing them, don't stop. If you stop, there is often very high correlation between when the monthly updates stop and there's bad news on the horizon. So if you start, don't stop. That means that you got to communicate some of the losses alongside of the wins in those things. It's a way of, how you message it and how you're managing some of that. But I think that there is, it's probably a set of conversations. This is what I'm thinking about. This is what we've learned. This is what we're thinking about doing next. It may require more capital. We're not sure we'll be ready for the next priced round, if that is the intended goal. And kind of having the conversation, or, I would say start with a conversation and then firming up, what the investor would be thinking about, and what they would be looking for in order for them to be willing to participate. And then I think as a founder, you should also be holding those investors a little bit feet to the fire. Like, you told me to do, you told me if I did this, that you would think it was a good thing, not supposing that there's money behind it, but we sort of agreed that this was the next thing we were going to march after. If you see a little bit of creep there, that's probably a flag. So we try to be very careful about what we communicate, and we think are reasonable expectations on our side as well. So I think a founder should be listening for that as well. So I think it is a conversation rather than an email. But I do think if you do start the monthly or quarterly updates, that you should stick with them.
Yeah, maybe the thing I'll say here from personal experience. So we raised a seed round. We needed a little bit of extra cash, not a lot, about 10%. We called it an extension. You could call it a bridge. But one of the first things that we did was that the moment we said, oh, we're going to need this extra cash, there's no way that there's like no amount of finagling that we can do to get there. We called our lead investor from our seed round and our largest investor otherwise, and we didn't call everyone. because we wanted to get an understanding of how people would react. And the safest people are basically your largest, if they're not your lead investor, your largest check holder and your lead investor. And at least there you can get a sense of how they'll react to the information. You can tweak the narrative a little bit. You can adjust framing. And it was incredibly helpful. And, we ended up raising that bridge in, I don't know, like 30 days. And we did it, I think, 6 or 9 months before we actually knew we would need it.
Yep.
So
Mhm.
like, I think that was
Yeah, you did a
important.
great job, and I think it was one of those calls.
Yeah.
But I would just add for founders, if you're thinking about, how to approach fundraising, and particularly around, bridges or extensions, you've all got your toolkit around go to market and finding product market fit. It is very similar. So starting like I think you could think about it as like customer discovery, like who are my first customers? Like think about those existing investors in your cap table as like your early anchor customers. You're going to roll out a new feature or functionality. Like how are you going to test that? What's that conversation like? So I think that you've already got a lot of the tools in your toolbox to be able to like march this finding product market fit for the next round of funding down the road because you're doing it in your go-to-market activities. It may be to sort of clear some of the haze and some of the fog around how to do it. Think about like, okay, I got to just use the same tools that I have in my toolkit for go-to-market in my kind of figuring out what the next round of capital is going to look like.
I think that is an incredibly salient point, because I think investors need this level of transparency, but they also need to know here's what's going wrong, or here's what I'm not sure about, and here's what I'm doing about it. And that level of, I think we've talked a lot about like, well, it depends on how you message it, or it depends on how you frame it. And like, I think in general, for bridges in particular, not everything's going to be perfect. And so for your internal communications, especially to the existing cap table or insiders, this kind of scenario planning of like, hey, we're not going to have enough money to raise the next round. Here's the different ways we could bridge. Here's how I could riff. Here's what could happen. Help me think through these decision trees. What am I missing? It's a level of communication that I think helps investors have the confidence that you're not hiding anything, that you are actively addressing those problems head on, and then you're not quite asking for money, you're asking for advice, which is like one of the best ways to fundraise, right? And then you can get real steerage down the parts of that decision tree, which is, should we go for a bigger raise, a smaller raise? Should we be deploying it here? I think my core problem is that, we're having too much churn, and here's what I think could fix it. What am I missing? Those like second order questions, I think, can help you engage your investors to the point of a bridge so that you all have clarity, especially on like, what is the hypothesis we're testing with the bridge? And if you run it like customer discovery, to Ben's point, you can also add a level of empathy to your investors, which is, hey, we might be able to offer some favorable terms, which could grow your ownership to this percentage. I envision that if we do de-risk this churn problem, our revenue should grow by X percentage. And therefore, at our next round, I would hope valuation increases by 3X. And here's how that impacts you, venture capital investor. There's an element there of like, just the same way that you know your customers ins and outs, you kind of have to treat your investors the same. But at the end of the day, they should be aligned to the same outcomes you are because of their ownership. So just a comment on like messaging. I mean, let me put it this way to underline the transparency point, and then I'll pass it back to Dimitry. I had a churned executive from one of the teams who basically called me up and was like, hey, that like large, 8-digit contract value deal that they said disappeared because the team dissolved within the large corporate. Actually, it fell apart because of the startup's negotiation, and that's part of the reason why I left. And like, if you are not that level of transparent with your venture capital investors, you're going to lose way more than just the $500,000 to $1 million they're going to invest in a bridge. You're going to lose trust for forever. And you just can't earn that back. So the transparency of, we lost the contract because we couldn't nail the negotiations, and therefore we need to improve our commercial sales muscle. Those are the real conversations worth having, but you have to approach it with and this is what we're doing about it.
Yeah, I could not agree more. There's a question in the chat. I want to actually come back to that. I'm going to table it because I think that's a deeper conversation, like a deeper discussion. I want to ask this question of everybody in the panel. So, and maybe we'll start with Orrick, Alex, and then go around. But um, one of the
I'd
things
love
that's
to get
really
some
hard
new
about
name.
I know we're doing great. We're doing great. It's wonderful. I love it. One of the things that comes up a lot with bridges, and this is sort of we talked about this a little bit before, is that um, the leverage, the dynamics between investor and founder are really challenging because you're like, I'm going to run out of money. I need help, and that basically means that your investors have all the leverage. And one of the things that I have always been curious about, and I've seen some examples of this, but would love to hear it from you guys, is like, how can founders regain some leverage to not get totally hosed in a bridge, right? Like, what are the things that they can do? And and I imagine there's some of this is about process, some of it is about framing, some of it is about intangibles. But I'd love to hear, Alex, in your experience what you've seen, and then we can take it across the panel.
I think going from where we were starting with the communication with the investors, if you've been having regular communication, there's a trust built there. So it's not necessarily, mutually opposing forces, that you're moving in the same direction. It benefits the investor too if the company continues and can get the capital it needs to continue on its trajectory. So I think that it starts well in advance of when you need to actually negotiate the bridge, having good open communication with your investors. And including on the board, if you're doing a bridge, you're likely have raised around and you have an investor director on the board who can also help advocate for you with the other investors. So there could be a champion existing investor too that will that you have a close relationship, you're aligned and can help forward the terms that you are more inclined to accept.
Anybody else want to chime in?
I mean, the best leverage is outside money. So starting with your existing cap table and the folks that the best leverage you can get is somebody else, but willing to pay, or has better or different terms. That's the best number of term sheets is always N+1. So I think getting some
What
outside
percentage
interest.
of bridges have you guys seen in the last 12 months that have outside investors setting the price? Real, like I'm just curious. Is it 5%? Is it 1%? Is it 0%?
I'll speak from my anecdotal limited experience, less than 25%. The bridge rounds have had more insider investors. That's not always the case, but particularly I think in this market, that's what I've seen.
Alex, I think your experience is much less limited than all of us put together because the number of deals that you're seeing is, yeah. So I'll take your experience over my experience any day of the week.
Yeah, or even outside, I guess another, lever is the, just having an outside investor or a new investor join the round at the terms that are set by by an existing investor. That is a good thing. It's probably it's something that a lot of the insiders are going to be looking for is like, okay, who else can believe alongside of us? And that will be, I know we're going to get to milestones, but like that's going to be something that you're, as a founder, you're probably going to hear.
I've
Yeah,
also seen I've also seen, while not a true outside investor, but an existing investor who has a really small stake in the company then come out to be a lead. So that's another variation on this.
Yeah, to expand on that, yes, 2 term sheets is better than 1, and your investment syndicate is not always monolithic, right? So, and again, it depends on the stage of the company, right? Earlier, you have fewer investors on the cap table. Later on, you have different investors that have come in at different times, that have different time horizons, that have different priorities, that have different amounts of cash on hand, right? And so your investors will not, they're not a monolithic unit, right? They are they are their own people. And so different conversations with different investors might yield all inside, right, might yield very different outcomes. And so, yeah, it could be somebody with a small stake. It could, VC horizons, VC time horizons, fund horizons. There are lots of mechanics as to why a VC will or will not, fund a bridge that have nothing to do with your company or your progress, right? There are lots of reasons for a VC to propose another term sheet, increasing stake or something else, right?
Yeah.
So
I think maybe the only thing that I would add to this, and then we can shift, is just that pricing is only one aspect of a bridge, right? And you can give investors a lot of other things that help them feel like they're getting the bang for the buck. It could be warrants, it could be different liquidation preferences, it could be a board seat. There's infinite tools, and we're going to get into this, like legal. This is the next step, is like what happens when legal goes right or wrong. But I think one thing that's also important is that if you do want to have different insiders kind of play off of each other, you have to be really careful and thoughtful about how you engage them and when you engage them, how you build those relationships over time. And you can also, at least I've seen this work in some cases, not all, but you can make sometimes the argument that a bridge that is too punitive can have material signaling problems, both within the existing community of investors and future investors, in a way that will mean that no further funding will hit the company at all. And in some ways, like actually getting too creative with a bridge can also have those same effects. And so let's get into that, Hannah.
Yeah.
Back to you to take over.
Okay, I love that. And I think this commentary about like the internal like dynamics of your cap table is important. I really don't think venture capitalists should let their own business get in the way of the founders building their businesses, but I have seen investors who say, well, we really like the company, we would participate in a bridge, but like we need an external lead because we don't want to mark up our own books, but actually we're about to go out for fund 4, and therefore we need somebody else to kind of come in and do this. And like therefore you co-lead on our last round. We don't want you to do it either. So like, sometimes you have to be aware of what those dynamics are for your funders, which I think is unfortunate, and the best investors don't let that play too big into it. Why don't we talk a little bit about like the tactics of getting these rounds done? I want to come to Alex Wood specifically about like what are some of the top, like let's get into terms, let's get into dilution, let's get into the nitty-gritty of these rounds. What are some of the top legal red flags that sometimes get hidden in these docs that founders overlook or don't catch?
Dimitry raised it as a positive, but it can also be a negative, which is other rights that investors may require to get their agreement to participate in the round. So those could be through side letters with new veto blocking rights, consent rights, like for where they'll block a potential acquisition, or even more nitty-gritty kind of consent rights where they're getting much more rights to run the day-to-day of the company. Additional rights such as board observer rights, which fine if there's a couple, but you might end up with a board with many people at the table. So one is just overall investor rights and including control rights. Then on economics, there could be, for example, a note with a short maturity date when it comes due, which can then put you in a difficult position where it's repayment or renegotiation of that note to extend it further out, which again can lead to potentially more control consent rights, high interest if it's a note, and other economic rights that will play out in the longer term. In addition, most favored nation rights. So a right if there's another debt instrument, for example, or a note or a safe, that if it's on better terms, these investors will then have a right to get those terms, which could lead to a lot of dilution down the road if you need additional bridge. That's pretty much a summary. I can go into more specifics, but interested to hear what others.
Those are super helpful. And I want to expand on what you mentioned about like, look, sometimes the economic rights can really blow up like landmines down the road. Ben, do you want to chime in on how dilution gets in the way and also how investors think about the price signal that might come from a safe valuation cap or a convertible note cap?
Yeah, I just would add one thing that
Please.
Alex was talking about with the maturity. The convertible notes are very different than safe notes, and founders should be aware that a convertible note has, it's a debt instrument, so it's got a maturity and an interest associated with it. And so, and a safe is just sort of an open-ended thing unless it's got an automatic conversion in it. So you should be very, very thoughtful about that because in a convertible note in particular, it'll have things like a qualified financing event or, the amount of interest that you owe. All of those things will come into play as you get closer to the maturity. And there will be a tremendous amount of leverage that the holder of those notes has, probably at the most inappropriate or uncomfortable time for the founder. So you should be very thoughtful, and Alex and the team at Orrick can really help with these types of things, is like thinking through, all right, we're going to sign a convertible note with 2-year maturity. It's got an interest rate associated. Well, I wouldn't have to pay interest with a safe, but that's okay. I'll just sort of punt that. There's going to be a lot of other complexity associated with a convertible note that you should be very, very thoughtful of beforehand, because it's likely when that note is maturing, there's also hopefully going to be a financing round. And if the financing drags out and the note matures during that period, there can be a lot of like swirl around that. So,
Absolutely.
sorry.
And also, no, absolutely. Because in another, then a note will also have certain change of control provisions, what happens at exit, which are much more onerous than in a safe. They can get, an investor can get 2x, 3x the note in a sale of a company.
And that's senior debt. So this is important, right? If you're exiting and you're carrying a convertible note with, let's say, 2 or 3x slick pref, then, right, that chunk gets paid out first before your preferred investor, before the preferred get paid out, right? So you may...
Debt sits on top of all the investors.
Right, debt sits on top of everything.
So that incentivizes investors to want the convertible note versus a safe that doesn't operate like debt on a cap table.
Right. And this is especially important if you think that you are raising a convertible note as a bridge to a round. And instead what happens is, for whatever reason, you're getting acquired or you're exiting. Right. So if you think that you're raising as a bridge to a round, then you're not paying attention to the lick pref. And then all of a sudden it becomes the most important thing, and everything else, all the other things are less important because now this is senior to every other obligation.
And one thing, stepping back, that it's best to have a term sheet. So that has all the terms if it's going to be a convertible note, or if it's a safe, or potentially an extension if there's anything changing in that extension round. Because if you have that laid out at the outset, that will that will help prevent delays in having to negotiate those terms while you're drafting documents and exchanging documents back and forth with investors. So I think a term sheet is pretty key so that everyone's on the same page at the beginning of the transaction.
Ben, it looks like you might have had some thoughts here. I wonder if we could banter a little bit on these two questions in the chat, which I think are really around timing and then sizing depending on valuations. So like if you're going to raise a much larger round, but you just need a small bridge and your valuation has already kind of come a notch above, how do you find the right investors for that? Kind of avoiding that stuck in limbo. And I think there's this broader question of like, how do you advise founders not to how do you advise founders to raise bridges efficiently? I think there are some bridge rounds that are kind of about expediency. They're about getting a safe in the door and money to close a big deal or to, make a significant notch up in valuation happen. But you don't necessarily want to put in the work to have a full, proper priced round raise and a data room and all of that. How do you think about that balance? And especially when founders are tipping into Series A's or B's, how do you advise them to manage that time? And then I think Michelle's question here looks a little bit about like, there's plenty of runway, but like, does raising a bridge now push a Series A timeline raise into something uncomfortable like the holidays or create inertia that might otherwise not be there? Maybe Alex, I could come to you first, and then Ben would love your perspective.
Which Alex?
Alex Gershenson. Thank you.
Okay, we got it. So as far as timing is concerned, I mean, if you've got a very like you mentioned a hypothetical, right? You need to close a big deal or something. There's something immediate that is an opportunity, right? And you might potentially lose that opportunity if you don't have the financing and the opportunity is strategic. Then could you over-engineer it and get cute with the terms and stuff like that? Sure, but really, like, eye on the prize, right? If it's transformational to your business, just do it, because yes, you might get a little bit more dilution, but more dilution out of a much bigger pie, it's okay, right? So it's about again, it's about what is the bridge for, right? And what are you doing?
And what's your response to the founders right now who are saying, gee, the like Series A and B market, they've really moved the goalposts on me.
Yep.
Like all of a sudden, my 2 million in recurring revenue, not good enough. I need a book of 6. Like, how are you advising those founders? Should they go for the bridge? Should they try to run runway tighter and go for the A? Like, even though their metrics might be lower, the valuation might come in lower. Like, how are you seeing that play out?
So I actually have two clients right now in that very spot, with completely different strategies, right? Where one is saying, look, I'm just going to take a lower valuation on a price round. And it essentially is becoming a bridge. I mean, there's a tiny bump up in valuation, but it's not like a major bump up in valuation. So it's not exactly an extension, right? Because we just need to focus on getting to our strategic goals that are 2 years forward. And then I have another founder who is actually trimming the team a little bit, trimming the goals a little bit, getting extending the goals, not trimming the magnitude of the goals, but trimming extending the timeline when they're going to hit the goals. They're putting more money, getting more money in the company to ensure that they hit those goals. They're just going to get hit later. And so they are extending it because they understand that they're not going to be able to raise an A at the numbers that their investors want, And with that founder, the investors are actually driving that because they want that bump up, right? And a safe is actually helping their fund, to Ben's earlier point, right? In this case, and to your earlier point, sometimes investor fund dynamics will drive the conversation, and your lead investor might say, hey, let's just do a safe. And they might not say it out loud, but it's because they don't want to have to report that IRR number to their LPs. I mean, that's real, right? Nobody, Ben, I'd love to hear your take on that.
Sorry, Hannah, and I'm just going to repeat. I think I'm going to repeat or rewind what I think the question was, and I'll just frame it the way that we sort of think about things, and it's overly simplistic. There are three buckets of bridges. The first is we need to raise more money or we're out of business. And that's really the reason, right? You can't really ascribe any other, there's still just hope and belief, and we're trying to believe and we're not sure and haven't really seen anything. That's unfortunately that's an easy thanks, but we're going to politely decline here. The other end of the spectrum that I think you referred to is we want to raise a small amount of money for a couple of different reasons. Either we've got this commercial opportunity that we need to hire for, or we need working capital for, like things are going a little bit better. We don't have time to raise the big round right now. We're not quite there on valuation. This is an immediate opportunity. We just need to raise a little bit of money. That's a much easier yes. Like that's very credible, especially if it's, let's assume that that's all backed by fact and truth and honesty. The second bucket in the middle is like, we're not sure. We think we need more time. We've got some commercial opportunities. Those are the hardest to sort of like wrap, like those are the ones that we and the founders spent a lot of time kind of bogged down in the mud. But let's just talk about bucket 3, which is the one that I described as being the easiest one for investors, particularly for inside investors. If you have that authentic, genuine, credit, like fully transparent conversation going with the investors from day one, you picking up the phone and saying, hey, we've got this incredible opportunity. We think things are going really well. We don't think we're quite there for a Series A. We need a little bit more money to be able to go execute on customer A, B, C, and D that you know about. And this isn't all new news, or we need some working capital to be able to fulfill these orders. That should be a very quick answer, right? And in most cases, I think it should be a yes, right? That's the business that we're in as investors, is like finding those opportunities, and we should welcome that opportunity of, this sounds like, like the things are going well, right? So I think that's how to sort of stage it out. It's just, the bucket 2 of like, we're kind of not sure and we think, and we're kind of like still, things are a little bit tenuous. There's still a lot of risk. Like we all still have to believe. That's the hardest one. And you can spend a lot of time on it. So it will take a lot longer.
Okay, great. I'm really hearing, what is the money used for? What does it unlock and in what time frame? And what do you expect the specific outcome to be in that time frame? And defining those 3 things to your investors make or break the decision to bridge.
And what's the pattern of fact to support all those things?
Absolutely.
Maybe one thing I'll just add too is that, and maybe this was said before, but I think it's worth framing, right? Like in the end, it doesn't matter what pricing you want for a bridge. Like whoever's giving it to you is going to set the price. And sometimes you have to decide whether or not like that is the price that's worth accepting for survival. And if you're going to people, I think this was the original question from Ehud was around, well, your current valuation is too high for us. Like if they're not willing to give it to you, you got to take what they're willing to give. I think the one way to solve this is to use an instrument like a safe where maybe the cap is a little softer You could also try to convince folks to just do a deep discount to your next round without setting a cap. I think some investors are very allergic to uncapped instruments, but it is a way to do that. So you can say, hey, like, I'm raising this. We have the metrics to raise our next round. I'm already talking to potential leads for our next round. We're already talking valuation. This is the indicative, like what I'm planning to get. So I'm willing to give you a 40% discount to that valuation, but I'm not going to set a cap. Right. And that way, at least people can start to like, they're going to put a price in their head of what that means for them. And it's another tool. But in the end, if they're like, hey, sorry, buddy, like this shit is worth 10 million to us, you got to take it or you're going to go out of business. That's what you got to do. All right, Hannah, back to you.
Well, Alex Gershenson, chime in on that. Like when you're advising these companies, like how do you advise them to prioritize or balance the legs of the stool across speed, governance, dilution, and optionality for subsequent rounds?
Look, I think one of the things, and in preparation for this call, Ben kind of mentioned it, and I want to throw this to him in a second. One of the most deadly things that you can do is overprice your bridge and have a cap in your convert that is very high, right? Because if you raise later at a lower valuation, all sorts of things go wonky, right? So I have seen companies that have raised at a valuation that was attractive to the founder in 2021, 2022, and then look at a down situation. I mean, to my brother's point, right? The valuation is set by the investor. But Ben, what have you seen when the round is lower than the cap on the note?
Yeah, it's really it's a hugely uncomfortable moment for everybody because the founder in those instances, the founder's just been heads down and raising money, probably, stacking money and safes on top of each other. In many cases, the valuation caps will be, they might be different, they might be the same. And if the round is priced below the cap, what the founder, the first kind of like big inhale they have is when they see the pro forma cap table and they see their dilution. And all of a sudden, they own 2 to 3 to 4% of a company that they've put blood, sweat, and tears in. And in some cases, they may say, well, frankly, this isn't worth it. And so then there's this like weird chicken and, like everybody's playing chicken. The founders are saying, well, you've got to, and it really turns into an uncomfortable situation for everybody. There's a lot of friction. So I would add a word of real caution here as you're raising using a safe in particular, and probably a convertible note as well, that you be very mindful as a founder of what happens if this converts below the cap. What is my world going to look like? And oftentimes it's not a pretty world, and you might be willing to just sort of take, okay, I'm going to take the risk and they'll plus me up. But again, then what ends up happening is in a lot of cases, the safe investors have to agree to like a down round, and that wasn't the promise that you made. And it's just, there's a lot of swirl. So be very, very, everybody thinks safes are just the easiest, quickest form, but there can be really negative consequences of being not thoughtful about how everything converts in a situation, in the unhappy situation where it converts below the cap. So we'd add that as a word of caution.
Would add modeling this out when you're at the convertible or other bridge stage is important, so that you're not modeling this out when the actual difficult transaction is happening, so that you can see ahead what are the potentials for dilution.
This is not rocket science. It's a pro forma cap table. It is like a little bit of circular references, but like if you work with Alex Wood at Orrick, she will do an amazing job for you. You have to do this work, and you like playing out those scenarios is so important. It actually takes 30 minutes. So important. Talk to me about, we talked about MFN. We talked a little bit in our prep call about pro rata and how that can sometimes get into stickiness. Open to all, have you seen any specific terms or anecdotes with companies of what's kind of gone wrong, things you would like to avoid in the past, or and then maybe we're going to spend the last couple minutes on just some rapid fire advisory here. Any last bit terms, valuations, structures?
Quickly on the pro rata, your existing investors, if specifically major investors who are usually are the largest investors on the cap table, they will have pro rata rights to invest in whatever the next round is, whether it's bridge or a price round. So you want to keep that mechanic. You want to be aware of that mechanic, and then as a negotiation tactic, some investors will ask for pro rata rights in the next round. And it's just, again, it's back to the modeling. It's important to see how that plays out, and that if that will result in more dilution, or like if not so much even dilution, but like if it will hinder you in the future when you're raising from new investor sources.
I wanna just jump in real fast on the pro rata. This is also where transparency with your investor comes in, right? If you've got an investor with a lot of pro rata and you're in the middle of a round, you can go to that investor and say, hey, look, I know these are your rights. We need to bring in this strategic investor. We don't want to blow up the cap table. Can we discuss how you would be comfortable stepping back from some of the pro rata allocation so that the company benefit, right? And sophisticated investors will be like, okay, I understand how this will work for the company's benefit. Pro rata is not set in stone. This is where the trust that you've built up over the years with your existing investors really, really matters, because I've seen investors not dismiss their pro rata rights, but leave room for the right investor at the right time for the right reasons and step back from their pro rata allocation.
Yeah, absolutely. Mechanically, it's quite easy to waive those rights. So it's about the communication with the investors.
Meaningful. All right, folks, in our last 5 minutes here, we're going to do one rapid fire question. I'm going to come to Ben, Dimitry, Alex Wood, and then Alex Gershenson. What is the one piece of advice you would give a founder who's kind of stressed, maybe embarrassed, or kind of stuck in their bridge?
Have an honest conversation. I think you probably think it's going to be worse than it actually is going to be. And reach out to your, probably advisors first, folks in your network, run some scenario, just sort of test out how you're going to talk about it. Make sure that your insiders are, fully informed, and get into a conversation with them. I think these are critical moments in a company's journey, and you got to be transparent. So
I would say the moment that you start thinking that you're not going to hit your trajectory and you might need a bridge, go sit down with your co-founders in the woods somewhere and spend like 3 hours talking about everything that you could do to avoid it. Right. And I think that conversation, like, cover every aspect, but also get creative. And I'll give our example. So when we raised our seed round, we raised probably about half of what we thought we could need or should need. And at that moment, when we started to realize that the market just wouldn't support our raise, we sat down, we said, okay, what can we do in the interim to support our cash needs to get our core business, which is lending, fintech lending to profitability. And that's actually how we launched our CFO, not side. I mean, now it's just like, it's our business in many ways. Like, that's why we launched our fractional CFO practice. That's why we started to do that work. And that has been an incredible source of revenue and cash for our corporate entity. And that wouldn't have happened if we didn't have that conversation in the woods. Woods can be a metaphor, but for us, it was actually very productive that it was the woods. So highly recommend that.
Level setting and understanding that a bridge is not a sign of weakness, that many of the eventually strong companies have used bridges in time to market and raise when their story is truly ready. And communication early on, which I think we've said multiple times, is important with your investors, advisors. And what will ultimately matter is having clear milestones, a credible plan, and that can help you work toward clean, simple terms that help keep the next round or exit open.
Yeah, I'm a math guy, so I'll go back to statistics, right? Founder's Dilemma is the famous book that analyzed close to 1,000 startups, provided a good data point for the likelihood of success, which is that don't worry about dilution as much because a smaller piece of a much bigger pie is what the bridge gives you, right? And if you don't take the bridge because you're worried about dilution and the company winds down, well, you have a bigger piece of a pie that is exactly zero, right? So focus on the strategy and focus on where you're going and what you're doing. And an extra couple of points of dilution today, it's not worth the distraction if you can move the company meaningfully forward and you can move the company to double your valuation.
Actually, I want to double click on the last thing you said. The amount of time you spend raising the bridge, that time suck, that pain also matters.
Yeah.
Like negotiating an extra dollar of valuation, don't do it. Maybe the last thing I'll say as we wind down, this is not legal advice. This is not financial advice. Speak to your attorney.
Yes.
If you need a good attorney, you can always hire Alex or anyone else at Orrick.
Not me, Alex.
Other Alex.
I'm not an attorney.
My brother's not an attorney. Thank you, everyone, for joining us today. We really appreciate your questions and participation. We'll share a recording and read out. We'll also share the LinkedIns of all the participants so you can reach out to them. And we will announce our next session probably by the first week of December. And maybe it'll be on founder top-ups and recaps, but maybe not. Thanks so much, everyone. Have a
Thanks,
great,
everybody.
Thanks.
Thanks, folks.
great rest of your week.